Good Thursday afternoon, everybody, and welcome back to another StockTwits Q&A session. I'm Brittany Umar, joined by Evan Lazarus. Hey, Laz.
Hi, Britt. How you doing?
Ready to dive right into these questions?
Let's do this.
All right, guys. Well, let's start with one from KG Trading, who says, Laz, what are your thoughts on the big divergence in the IWM versus the spiders today, close to 1%?
Okay, so let's talk about it. Russell clearly been leading. Russell's been making new highs. S&Ps have made new highs, but certainly not near the level of enthusiasm in the S&Ps that you've seen in the Russell. If we look at the IWM in the weekly, a little bit of a different pattern here. A little bit of a flat top resistance. Right? We broke out of that a few weeks back. You can make the argument you have a big, ascending triangle here. So this could, certainly go higher. I'd like to see a little bit of a short-term pullback before, potentially stepping in for what could be another rally leg there. And the S&Ps, very different structure. S&Ps have been making, a series of higher highs and higher lows, not breaking out of any flat top resistance. And you can make the argument possibly upper trendline resistance over there. So I wouldn't necessarily dig too deep into divergence. One could be up one day, one could be down. They're not necessarily with the same pattern. They don't have the same structure. There's not the same technical underlying principles there driving one that's driving the other. Both are going higher. Both seem strong. But I wouldn't look too much into the day by day, whether they correlate or they don't correlate from day to day. I think you're probably going to wind up missing the bigger picture there. So I wouldn't spend too much time or energy trying to uncover some sort of enigma, because truthfully, they're both going higher. Both are making higher highs and higher lows. But to look at it under a microscope on any particular day, you're probably doing yourself a disservice in the long term.
Is there any situation in which you would compare the two?
If it was dramatic, if we're talking about something changing overall in the broader structure of things, meaning, where we had a day where it was a day of, a day to take notice, I know as Scott says, something dramatically changes. But to look at the minor ebbs and flows, 0.5%, 1%, on a day to day or even over a window of a couple days, to me is probably trying to make something more than maybe what needs to be looked at.
Right, so not close to 1%. That's right. Not dramatic enough. No. All right, let's answer David P3, who says, Laz, can your active trader techniques translate well to a multi-day time frame and be used for swing trading? Absolutely.
All the principles that we teach in the active trader program, can be applied to day trading. They can be applied to swing trading. It's a concept of understanding your strategy and which time frame you operate from. One of the biggest misconceptions, I think, of trading overall, especially in the active trading crowd, whether you're day trading or swing trading or what I consider, something short term, is that it's different. It's not different. The time frames from which you enter and execute are different. Which dictates ultimately the risk reward scenario. Swing traders and day traders essentially do the same trades. They just have different time frames. Whereas, a day trader may be in a trade for an hour, 2 hours. I might be in the same trade for 3-4 days with the same underlying approach. And I can show you an example of that. This is, again, something that I'm looking at. Again, here's IBM. We're going to look at the near-term chart. Big topping tail, 3-bar retracement, and then the stock begins ultimately what should be another move lower. Again, very strategic setup here. You look at the same chart, different symbol. Here's HES, H-E-S. Different time frame, right? Same concept. Right? Here's a big topping tail, 3-bar retracement, and again, a move lower. So you can see that the strategy is essentially the same there. The time frame from which you execute off of is different. So ultimately, the time frame dictates whether it's a day trade or a multi-day, swing trade. So the concept is the same. It's just where you execute and enter the trade from, and the strategy you use that ultimately is different. But the underlying foundation is absolutely identical.
Okay, Manax T is asking, well, first he says, thanks for an amazing trading lab last week. What are your thoughts on EOG resources?
Okay, let's look at EOG. Actually, last week we did a trading lab in-house, and we had about 20 traders here, all learning from the active trader, principles and actually putting it together real time here on our trading floor. Outstanding, unbelievable week. I actually had a lot of fun as the instructor. But EOG, let's take a look here. Let's do a little time frame analysis. Here's a weekly, right, just to get a bigger, sense of bigger picture. Stock broke out back here roughly. You can see your pivot highs over here, and again a breakout. As of late. So this could, develop into a larger trade. I'd like to see it hold the breakout, meaning, for those that are in the swing trading arena, above 118 to me is really the level it should hold. This was basically your last pullback right here, and where the stock, launched from. So I want to see it hold that last pivot low. It looks to me on a weekly, the stock is slowly going higher. If we time down, go to a daily chart. Again, you're going to see the same structure, same type of thing, just a little more back and forth. I don't love this. This is the daily. I don't love the topping tail from yesterday. You can see, volume was about average. I don't love the topping tail, but nothing really changed. I think if you want to lighten risk here, if you want to, take off some risk, just using my lines here, trying to get my data correct. I'd love to see the stock, this EOG hold the 123 area, hold this upper, channel that it's been in. Obviously, topping tail is not what you want to see. You want to see the stock, break out of this, multi-week channel and continue higher. So keep it close to the vest here. Stock still looks good on a, larger time frame. Daily chart, a little more chaos in here. If you really wanted to, have granular risk, real tight, use this lower area, 123.5 plus or minus.
Back to that trading lab for a second. Are there any more plans for any more of those in the future?
Yeah, we plan on doing trading labs. We do them every couple of months, and it's an opportunity for, people to come in, work with me, some of the other instructors, on a 5-day in-house, lots of personal time, really sort of work out the kinks that everybody sort of has, and, address your own individual issues, and learn, obviously, in a group setting, in a trading floor, not via the web, really much more, personal interaction, which is always good. I would say check the website for, details on the next lab, but should be within the next 2 or 3 months.
Sounds great. And actually, Turtle Trader right here is chiming in about the Active Trader course. He says, could you give an example of a catch play from your Active Trader course? He saw Rich from T3 Live reference it on StockTwits. Okay.
So catch play is a short-term reversal trade. A lot of day traders gravitate towards catch play. So here's an example, one we took today, actually, in Facebook, and it happened pretty early in the day, just so you can sort of see. A catch play is basically when you have a short-term shift in direction. So here's an example. Here's a 5-minute stop. Here's a 5-minute chart of Facebook. Again, this is from today, just fresh in my mind, where you can see the stock basically gap down. It rallies up into a 21. At the 21, you can see it pulls back to the 8. It's now catching into this rising 8 EMA. You can see this tail up right here on this 5-minute chart. This is a catch. So the stock pulls back and catches into a rising average, creates a pivot right here, and you can see from that pivot, it then continues to leg higher for the better part of the day. So again, they're short-term reversal trades, very easily identifiable by moving averages and pullbacks into rising or declining moving averages. Definitely a hard trade because it tends to be a short-term reversal, and short-term reversals can be very, quick, fast intraday trades. But an example of a catch play right here on a 5-minute chart. Something on a higher time frame. Mellanox, different, again, example of a catch play, possibly on a different time frame. Hasn't quite caught yet, but you can see this stock rallying up into a 21. If this stock eventually pulls back into this 8, and again, it hasn't happened yet, and this 8 starts to turn up, this blue line starts to turn up, you might see another powerful surge higher in time. So an example of something that may develop into a catch play, hasn't quite yet, but Facebook, clearly an example of something that we looked at as early as intraday. Facebook, FB, from today, just showing you that catch play from earlier in the session. So those that were in the active trader room today identified that trade because we've seen this, you see this pattern from time to time.
You just showed the chart of Mellanox, and we have Terry here that said, thanks for Mellanox today. She says she's new to the VTF and wants to know your thoughts on VMW and eBay.
VMW, no problem on the Mellanox. Again, we're here to, our job is to find areas to mitigate risk. I say this all the time. Good trading, and I'm gonna rant for 2 seconds. Good trading is all about, it's not about being right. It's the one thing that I stress to everybody, all my students. Good trading is not about being right in a trade. It's not about being long and watching the stock go up or being short and watching the stock go down. That's being right. Good trading is about understanding and analyzing risk, knowing where pockets of risk are smaller and pockets of risk are greater. We use charts and visual representations of the language of price to determine where those areas are. So good trading is really about, low risk situations. And Mellanox, the trade was really right here. Again, just a very controlled setup, strong impulse up, very controlled 3-bar pullback. Those those that were familiar with the setup, we bought right here through this, pivot low 2 days ago, and again resulted in a nice 2-day trade. And looks to me like it still has potential to go higher, but that's exactly what we're talking about. That's not about being right. It's identifying where the pockets of risk are minimal. That's what good trading ultimately is about. So, question, VMW. What was the question? What do I think of VMW?
Yeah, just your thoughts on VMW and eBay.
Okay, so to get my thoughts on VMW, let's look overall. We're going to start big picture and funnel it down. So, here's VMW, and this is a weekly, so we can get a clear sense of what the stock has done overall. So there's a couple things that jump off the screen here, if you will, as a technician and someone that studies the language of price. We have clear level of support, in this area. Again, support is not a specific number. Support resistance concepts are generally dealt with in areas. You can see multiple touches in this general area going back for the better part of 2 years, right? So we're approaching a very, very substantial area of support, okay? But the other thing I want to point out here is clearly in VMW, something is changing. This is a very, very ugly looking, heavy volume, impulse driven candlestick. This is telling us that the crowd is desperate to get out of this particular trade. Now, that doesn't mean it won't bounce, but my anticipation here in VMW is that something is changing. Now, you might see a trade through support where it actually breaks support or that area and then snaps back, but that snapback to me is probably an area that could be shortable. So while I wouldn't suggest trading it here at this level or doing anything with it because it's pretty extended in the short term. If we go down to the daily, pretty extended down here. Your 21 EMA down here, stock down here. Now, that doesn't mean it won't go down tomorrow or it can't probe lows. Chances are it's probably going to continue to push down, but then snap back maybe pretty violently. So I'd be very, very careful here as you have a stock short term that is flirting with a break of major support, but is very short term extended to the downside. So if you're going to trade this, I would stay with the short term approach, stay on the short side of the trade, but I wouldn't look for a huge move down from these levels. You might see a little bit more downside here, but at some point it's probably going to snap back. That snapback should make a lower high and should ultimately resolve itself into some larger down move. So you kind of have a short term pendulum here. I see short term down, but I do see a snapback at some point in the near future. Just a question, it's just a question of how you want to trade. But overall, something in VMW definitely changing here. That's a candlestick you have to pay attention to. It tells you something about the impulse and the psychology of the crowd right here, right now. And what was the other one? eBay?
Yep.
eBay. Well, we look at a weekly of eBay just to get a big picture. Rising 8, rising 21, 45-degree slope here on the 21 EMA. Good trending stock, higher highs, higher lows. Pullbacks are being bought, trying to be as concise as possible. Stock still looks like it wants higher, although it's short term. It's had a nice run. I would trade it probably off a daily. Again, here's your daily. Pulling back into the rising 8, you can see today was bought. You might see another short-term breakout here. If the stock clears highs again, this stock could give you a nice, a nice surge higher. So I'd look for a breakout here. All signs to me look like it wants higher. As far as risk goes, you want to keep a really tight stop. Use this pivot low from a few days ago. That's about 55 and a quarter. Is that right? Yeah, about 55 and a quarter. If it breaks 55 and a quarter, it could pull back to this 21. So, but like I said, right here, right now, it looks to me like the stock still wants higher prices.
All right, let's talk a little banks here. LP767 saying Wells Fargo has been the laggard among the banks. It's traded in a tight range since the new year. Is this consolidation healthy, and what would be a good spot to add tier 2?
Okay. Wells Fargo does not, to me, have the same characteristics. I think there's better trades on the board. I guess if I can paraphrase it, I don't know that I would spend a whole lot of time or energy here with Wells Fargo. If I take the candlesticks off, okay, and I tend to do this from time to time, let me just adjust my studies here so we're all on the same page, right? And all we look at is, my key moving averages. Specifically my 21 EMA. I basically have a flat 21 EMA. It's not a 45-degree slope up. It's kind of flattened out. We had a nice move, kind of flattening out. Price to me is consolidating. There's not a lot of reason to be here. I don't think spending a lot of time or energy in this place trying to stick a square peg in a round hole is the right approach. It still remains a relatively strong stock. It's going through a period of consolidation. I'd look to buy it on a pullback into this 21 EMA, which is right around 34, low 34s. I'd love to see it hold this lower pivot range, basically where it pulled back last time. That is this low, 33.66 would be my line in the sand. In the short term, if it breaks that level, I'd probably steer clear of it for a little while. Something could be changing. So to me, it's right now, it's not really much of a trade. Like I said, I wouldn't spend a whole lot of time or energy here. If it holds and you start to see it leg back up and these averages start to turn up, you could add another layer of risk there or tier 2.
All right, let's talk a little Apple. Turtle H saying, what do you think happens first? Apple fills its earning gap up to 505 or old gap down to 425?
505 or 425? Which comes first?
Yes.
Is that really the question?
That's the question.
Okay. I don't know if I agree with the question of which comes first. Let me kind of give you my overall analysis of the chart here, and then you can take it, digest it, and process it, and maybe formulate your own answer on that question. This is a weekly. What do I know here about price? Well, we had a large price movement down. We bounced, again, into the 21. Notice where it failed, right here at the 21 EMA. And that's given us, again, another large price movement down. We're still below declining averages, still telling us the overall trend is weak. However, down here, stock is pretty extended off the 21 EMA. Every time stock extend up, they tend to gravitate and bounce. So I would potentially look for a bounce here in Apple. You have some pretty substantial support overall down here, which means that, again, we may see another new low. You may see new lows here. Again, it doesn't mean it has to bounce. But to me, it's a much higher risk area of being short. That doesn't necessarily make it a buy. So to me, it's a tough trade at this level. Let's look at a daily chart, a little more granular detail. Here's the daily. Big earnings gap down. It has given you a little bit of a bounce. Notice the bounce here into that declining 8 EMA here on the daily. This to me not really showing a whole lot of enthusiasm yet to the upside. I want to see buyers come in. I want to see some energy. I want to see some impulse. I want to see some enthusiasm here. Not a lot of enthusiasm. So to me, the short-term picture is telling me, this downside may not be done. If we do take out a prior bars low here, you might see another trade back down. But like I said, bigger picture, it's going to approach an area of pretty substantial support. That doesn't mean it has to hold, but again, there's cross currents here. I would probably, if I'm going to trade it, stay with the smaller picture, the daily chart, stay with this near-term immediate data versus focusing on the weeklies or monthlies, because this is really going to help steer and make those decisions. My gut tells me we probably test into 420, 425, plus or minus before maybe bouncing. But we'll see. Again, my job is to study the language of price. My job is not to pick a bottom or tell you where it's going to bounce or where it's going to go. My job is to tell you where the risks are the least. Right now, I'm not seeing anything about the language of price that supports really being a buyer. I do think the stock is extended. I do think we will eventually find a much more substantial area of support where the stock will see a much more enthusiastic upside type of trade, just not yet. How's that?
All right, that works. All right, but you guys are asking great questions. Keep them coming. We're going to take a quick commercial break. We'll be right back.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, We teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Welcome back to our StockTwits Q&A. We're answering your questions live. We have one from Mojo here who says, keep up the great work. The T3 Live team is inspiring, so thanks Mojo. But he wants to know your thoughts on MFC. He says, is it a buy at the 21-day and trend line?
Did you see that commercial?
I did. This guy, he's everywhere.
I think they need a new actor. I think they need a new actor. What do you think?
No, I think he's great.
Oh, yeah. What was the question?
MFC. Do you think it's a buy at the 21-day and trend line?
MFC.
Still thinking about that commercial.
Sorry. MFC. Not a stock I'm real familiar with, so I'm not going to proclaim to have the best data here. But let's look, as a technician, I don't necessarily need to have familiarity here. I just need to study price and evaluate the movement. This to me, this is a monthly. This is bigger picture, again, going back as far as 2007, 2008, so on and so forth. Not a real strong stock overall. I would say that I like the price action down here. You can see that $10 area has really built a nice area of support. Now, that being said, you've had lower highs, lower high, lower high, right? But this time, when we popped, we took out a prior pivot high. So this trend, essentially, based on the data, this downtrend is now essentially over in terms of how we define trends, okay? So while I like the price action here, I would look to be a buyer on a pullback. So what I'm saying is I would like to be a buyer. Let's go to a weekly. I would use this weekly time period. Any pullback into this 21, which is right now about $13 plus or minus, is the area where I would look to step in as a buyer. That to me is a very calculated trading zone that I would look to then, put on some risk in terms of, where risk is the least. That to me is the area that I'm a buyer of this stock. And, if the trend is essentially down, you should get some sort of, pop from that area. So keep an eye on a pullback into 13. That to me is a smarter place.
Okay, Turtle Trader here is chiming in with a couple questions. He says, first, Laz, what do you make of the lack of volume in the market this year? Is it cause for concern?
A lot of talk about volume. Interesting question. Turtle, smart question from that Turtle guy. Hard to answer, and I'll tell you why. Because there are so many people that are, if we look at the market, again, we'll use the market sort of as a gauge here. There are so many people that talk about volume. And I understand volume is the engine, right? Volume is the engine that essentially gets the car going. But, volume levels, again, I'm going to show you sort of bigger picture here. Volume levels, this is just the market overall, have decreased. Whereas just sort of bird's eye view, volume increased. Volume has steadily been, decreasing over the last couple years. Now, that's not a reason to do something. Because volume decreases does not mean that price can't still go up. We still have to respect the most important thing. Traders make their money from price. Price goes up, price goes down. That's where we sort of hone our craft and make our money. So we have to respect the language of price more than volume, in my opinion. Not to say we don't take note, but it's not a reason to execute something. It's not a trade. You're not trading volume, you're trading price. So what do I mean? Well, we still have to respect the fact that we have consistent higher highs, just showing you price, and higher lows. We pull back, we make new highs. We pull back, we make new highs. Now, although the highs are starting to become a little more marginal, meaning we're not making grand new highs, we're just making subtle new highs, until that changes. Or until that changes where instead of making new highs, we start to break down, we make higher lows, that type of thing. To me, that's way more important as a trader than what the volume says. Great, we know volume has been declining, but it's been declining for 5 years, and the market has been steadily higher highs, higher lows for years at this point. Could it change? It could change, but it's not my job to figure out if volume's the reason. I do take note. Again, it's just data. I teach all my traders in Active Trader, you're data collectors, you're scientists, right? You're evaluating data to make strategic decisions about risk. We take note of the volume, but it's not a call to action.
Well, perfect follow-up to that then. He says, what other indicators do you use besides price and volume?
That's really it. That's really it. Those are my driving forces. Price tells me when something changes. Volume is the engine. So when I see price change, and again, VMW is a good example of that. Price has changed. No, my chart's not coming up here. But remember that VMW chart that we referenced in last segment. Price changed, big volume to support it. I know something has changed. You look at some of these earnings trades. You know, Amazon, big downside movement here at a prior high. Here's the Amazon. Again, it's an example of this concept. When this pivot low gets taken out, and it probably will, something will have changed. My point is that I really want price to dictate when something changes, not volume. When something does change in the market, you're going to see a big price spike down, you're going to see a big thrust in volume, and you'll know something has changed.
Okay, ITM Trading says, which time frame would you use to mark a pivot point for intraday trading?
You know, the time frames that I always recommend to traders for intraday are really 5 minutes and 13 minutes. I tend to gravitate more to 13-minute charts. They tend to provide a little more clarity for the day traders. Again, you can make a lot of money using 5-minute charts. You can make a lot of money using 13-minute charts. It's finding the trade setup really is the more important question, not which time frame. It's which time frame has the better setup. So it's not about a better or worse or only use a 5 or only use a 3 or only use a 1 or only use a 13. It's about where you see the trade. That to me is really more of the question for traders. Where is the trade versus why am I only using a 5-minute? You can see, again, when stocks are moving faster, 5-minute charts and 3-minute charts, you're going to get better entry points. Well, let me give you an example. This morning, I was trading MasterCard all for earnings. And the entry, because the stock had such speed attached to it in the morning, the entry was off of a 3-minute chart. Why a 3? Because I needed to go to a smaller time frame to see enough granular data to make a decision about where the risk was. Again, impulse down, that tells me something is changing, big volume. 3-bar bounce, lower high. Stock takes out a prior bar's low, and there's the trade that I was ultimately looking for. If I saw that on a 5-minute, it's not that I can't see it, it's just that in order to mitigate risk, I time down. When you have speed, you time down. When things tend to, occur a little slower, you can use, higher time frames. So it's a function of where you see the trade, not which time frame is the right time frame.
All right, Travel to Paradise. I love this guy's name. He says, Laz, with Deere, Cat, Autos, and China coming back, what's holding back the steels, AK Steel and US Steel? What are your thoughts on these charts?
We can look at U.S. Steel. Again, I don't want to get into the whole fundamental conversation. You can look at transports and say, well, why isn't steel? It's irrelevant. The market is really dictated on one general premise, supply and demand. That's it. If you start to try and rationalize, my job as a technician is to analyze price, not to come up with theories about why, what should happen and why based on another sector or news. My job is to, evaluate the movement, understand the language of price, evaluate price movement, analyze risk. I keep it in a very simple, concept. So what I can tell you about X as an example of a steel stock is that there's just no reason to be here. There's no buyers, there's no impulse, there's nothing happening in any of these time frames. This is a weekly, this is a monthly that supports really spending any time or energy here, saying to yourself, when is this going to come back? Because what you're going to do is, or what you could do is, you could spend a lot of time and energy here and make no money because there's not a lot of money to be made. When something changes, again, you'll see volume rise. You'll know something has changed. It might be a better time to get involved here with U.S. Steel or any of the steels for that matter. Again, if you're looking at price, obviously you have some layer of support down here, but again, not a lot of real impulse here, and there's not a lot of reason to go and spend a lot of time or energy here. So as opposed to saying, what do I think of steel or relative to transports, I'm just going to tell you flat out, this is dead money, and I try to stay away from dead money. Follow money flow. You want to be where the money flow is, or an outflow of money if you're looking for shorts. Trying to pick bottoms or stay with a dead sector, again, just not going to be a fruitful use of your time. Active traders, good objective technicians, have the ability to move as money flows. Know when something, is, again, we're looking to make lemonade here. You're not going to make a whole lot of lemonade here.
Nice analogy. And 3D printing stocks have been a hot topic lately. Turtle H says, do you think the 3D printing stocks, 3D and Stratasys, are a buy or a sell here?
I think that they're more likely a sell than a buy, and I can explain why. Again, it's not because I think something. It's because price tells me. Again, let's take a look at Triple D. Way extended. This reminds me of, this is a monthly. This reminds me of what stocks look like in 1998, 1999. You have a 21 EMA way down here. The stock has basically gone into a vertical up move, way off the 21. Very, very dangerous type of setup. And it's great while it's going up, but you have to understand that it can't support, this stock, again, let's go to a weekly, it can't support the rate at which it's rising. So when that rubber band, rubber band, camera.
Back to Laz.
Back to Laz.
Camera on Laz.
Bueller. Anybody? Okay, there we go. When the rubber band pulls, and it pulls and pulls and pulls, eventually it let go. The snapback can be very, very dangerous. So the reason I showed you the monthly chart is because I wanted you to see that at one point, this was all the way up here at 70, the 21 EMA down here. It's now a big, giant topping tail. Something's changing. Look at our daily, right? Big volume. Look at the volume. The engine driving it down, snapping back. Your ADMA has gone down. Now, do I think it can ebb and flow in here? Do I think you might see short-term pops or drops? Yes, I do. But I think something has changed here, and I think this stock is going to go into a multi-week, pullback, even pullback into, the mid to low 40s, somewhere in this generation. So be very, very careful about being a buyer of these stocks right here, right now.
Okay, Alpha 9 Trading says, what's the best way to recover when you start the day negative a good amount?
Okay, good question. It's really disaster management, and it happens to every trader. You take home positions, something changes, causes your charts to shift or prices to shift, and you come into what can be a very sticky situation. Again, it happens to every good technician. Part of being a good trader is to understand how to manage risk. So when you come into a bad situation, you're long a stock, big gap down, what do? You have to use your smaller time frames. And again, it's not about doing one thing, but it's about understanding the language of price so that you can try to prevent a bad situation from getting worse, or even knowing that, the stock may have the ability to come back up or retrace. Facebook is a good example. Facebook today, we were talking about a pre-market coming into a gap down. It was down $2 at the open. And I said, because you're 8 and 21, we're still rising here on the daily, they would naturally act as magnets, and the stock should have some sort of, at some point, find some short-term low, and you should see a bounce there. And lo and behold, here's a 5-minute, right from the open, buyer stepping in like a magnet and pulling it back up. So you have to understand, okay, how do I take a bad situation, how do I take a position of weakness and potentially turn it into a position of strength? And that doesn't necessarily mean take a bad situation and try and make money from it, or how to, if you're down a lot of money in a situation, how to make it less, how to potentially cost average in, knowing you're using appropriate technique to make a bad situation a less bad of a situation. So it's not something I can basically teach here and now, but it's really more of a thought process about the way you evaluate the short-term charts to help control disaster.
Eric B says, hey Laz, please explain the square box pattern frequently mentioned in the OTC newsletter.
Square box is, it's not rocket science. What it is, it's basically just a consolidation pattern. And if you look at a chart, all it is a stock that's basically consolidating in some sort of pattern. And they call it a square box only because price sort of ebbs and flows in a box, right? It's a consolidation that traders generally look for, a channel, a square box, whatever you want to call it, that we look for then some sort of breakout or potential breakdown. And that's really all that means. So when you read the OTC newsletter off the charts, if you see price consolidating in a sideways range, that's generally what that refers to.
All right. Warm trade winds. Hey, Laz, what's the skinny? Is there room to run on Deckers and Green Mountain Coffee? I'm long both. Where do I trim trail?
Okay, let's take a look at Deckers. Everything unto itself. You can't look at one. Deckers and Green Mountain have nothing to do with each other. Here's a weekly of Deckers. Looking like, developed into a little bit of a catch play. Notice your 8 starting to turn up. You have a nice pivot low here. So again, follow the footprint of money. Down, up, pivot, down. The stock then rallies all the way up here. So what does it do? It takes out a prior pivot high. That's great. Now we know the next pullback should be buyable. Pulls back. This is your new pivot low. The stock is buyable so long as it stays above 34. This should result in some sort of trade, possibly up into, here's the 200 EMA, or back up into, a more substantial resistance zone, which would be somewhere up around 50 bucks. So this is a weekly. So this is sort of bigger picture. That doesn't mean it has to break out, but I know as far as risk goes, so long as the stock is above this pivot, that's where risk is the least. Okay, so I like Deckers. Again, bigger picture. It doesn't mean it's going to happen all at once. Let's look at a daily. Kind of get more granular. Same picture. Again, up, higher low. All right. Little ebbs and flows in here. Pulling back again. Looks like it can, above this level here, could get going a little bit. I'd give it time. I'd stay with it. Like I said, the real level's 34. So that's your line in the sand in Deckers. Green Mountain, GMCR. Here's a daily. Looks good right now. This stock to me, gapping up, building a nice channel here. Is that kind of that box pattern that off the charts mentions. Nice consolidation, breaking out, volume coming up. There's our engine, pulling back into the rising EMA. This stock should make a new high, over the next couple of days. Again, this is more of a shorter term chart, and I would manage risk against this pivot low, which is about $43. So carving out areas of low risk for potential trades. Both charts, again, different setups, different strategies, different approaches, but understanding the risk in both.
Okay, cool daddy. Laz, what are your thoughts on GEVO and STZ?
GEVO, not a stock. Again, I'm not real familiar with this one, so give me a sec just to kind of eyeball this chart. Again, one of these $2 stocks, not my cup of tea, not something I would recommend for a trade. This is a broken chart, was once a $25 stock, now a $2 stock. If it's an investment, a long-term, core holding, again, here's a catch play. The stock should stay above this pivot low. That pivot low being $1.80. So long as it stays above $1.80, I'd say stay with it. But again, dead money. Maybe you get a trade back to 3, but not something that I would spend a whole lot of time or energy with. Mm-hmm. And what was the other one?
STZ, Constellation Brands, different kind of story.
I saw that one today. Something has changed. Let's take a look at the chart, right? Something has changed. Big volume, strong surge down. Again, I think you might see a little bit of a retracement, maybe a 2-day or a 2-bar bounce in here. Maybe over the next day or two. But what should happen here is your ADMA should start to turn down, and you might see another surge down, possibly into that. Again, it's a very, very dangerous looking candlestick, and it has to be respected. I would say if you're going to look at this one, look to potentially short a bounce or stay away from it altogether.
Turtle H, do you think the market is due for a big correction?
Well, instead of telling you what I think, let's talk about what reality is, okay? Because, I don't want to give you assumptions. Let's just deal with facts. Objective technicians, we deal with facts. Let's look at the SPX, which is the S&P, right? We'll use that as sort of our barometer. And let's go back and look at sort of a monthly, so we can get a big sample size of time. What do we know about this chart, right? This goes back to 1998, 97. We know that up here is a massive amount of supply. Every time we've come up here, large selling has ensued. 1, 2. So the closer we get to that level, the more that level needs to be respected. I think right now, trying to buy the market into this massive resistance, which is honestly just a stone's throw above, is a very, very dangerous type of trade. You are dealing with a chart that is a large area of resistance. So I prefer, it's not to say we can't break through it, but what I would want to see is I'd want to see the market break through that, then pull back, and then I'd look to be a buyer. That to me is a much more risk-averse situation than anything else. Right now, you have to respect that upper band. We could even turn down from these levels and pull back. Again, it's not about what I think, it's about data. This is objective data, the language of price. Respect these levels. We are approaching a substantial, you can hear in my voice, substantial overhead resistance level. Am I looking for a top? No, I'm not looking for a top, but I'm looking for something to change in the market. Again, let's go down to a daily, probably more of a time frame that we trade off of. Every time we've gotten a new high in the market, again, new highs, broke through this high back here, we pulled back. We make a new high, we could pull back. This move is quite old. We've come from 1350, we're trading 1500 in the SPYs. Could there be room for a pullback? Absolutely. Would I like to see the market hold? What's my real substantial pivot? Right here. I want to see this pivot hold. That's about 1450 in the S&Ps. So long as we're above 1450, I'd like to see a pullback. I'd like to see it make a higher low and continue. So we'll see, but I think bigger picture, you have to be very, very cautious about, putting fresh money to work up here. How's that?
Sounds good.
All right. Good.
All right, Les. Thank you so much, and thank you everybody for sending in all those great questions. That's all the time we have for today. Meet us right back here next Thursday for another StockTwits Q&A. Have a great night.